Medical costs are now the #1 driver of personal bankruptcy in America, and yet most people spend more time comparing Netflix plans than they do choosing their health insurance. Today we're going to fix that. This is the advanced playbook for managing health insurance and medical costs in 2026. The strategies that people who actually work in finance and healthcare use for their own families. Let's start with the foundational decision most people get wrong: choosing between a high-deductible health plan and a traditional plan. The conventional advice is that HDHPs are only for healthy young people. That's oversimplified and often wrong. Here's the framework that actually matters. An HDHP paired with a health savings account is not just an insurance strategy. It's a tax arbitrage opportunity that most people leave completely on the table. When you contribute to an HSA, you get a triple tax advantage. Contributions are tax deductible, growth is tax-free, and withdrawals for qualified medical expenses are tax-free. No other account in the tax code does all three. In 2026, the HSA contribution limits are $4,150 for individuals and $8,300 for families. If you and your employer are both contributing, you can stack these limits. But here's the move most people miss. If you can afford to pay your current medical expenses out of pocket, do not touch your HSA. Invest it. Let it compound. Every dollar you put into an HSA and invest today is worth significantly more in retirement, when healthcare costs will likely be your largest expense. You can reimburse yourself years or even decades later for current medical expenses as long as you keep the receipts. Now let's talk about plan selection strategy. The math most people run is add up your premiums for the year, then compare to the deductible. That's incomplete. The right calculation is take your expected medical costs for the year, add them to your annual premiums, and compare that total between plans. Don't forget to factor in what you'll save in taxes by choosing the HDHP and contributing to the HSA. For many middle-income earners, even with moderate medical expenses, the HDHP plus HSA combination wins on total cost. Open enrollment is also the time to do a network audit. Before you re-enroll in whatever plan you had last year, verify that your primary care doctor, any specialists you see regularly, and your preferred hospital are still in network. Networks change every year. Finding out your doctor dropped your plan on January 2nd is an expensive surprise. Beyond insurance selection, let's talk about the most underused skill in personal finance: medical bill negotiation. Studies consistently show that the majority of medical bills contain errors. Coding mistakes, duplicate charges, charges for services not rendered, they're extremely common. Your first step after any significant medical encounter is to request an itemized bill. Not the summary, the line-by-line itemized statement. Review it, then call the billing department. For large bills you legitimately owe, here are your negotiation levers. First, ask if they have a financial hardship program or charity care. Hospitals especially, particularly non-profit hospitals which are legally required to offer these, often have programs that can dramatically reduce or eliminate bills regardless of your income level. Second, offer to pay in full promptly in exchange for a discount. Billing departments would rather collect 60% now than chase full payment for months. 30 to 40% discounts for prompt full payment are not uncommon. Third, if you do need a payment plan, ask for 0% interest. Most hospitals will agree rather than send the bill to collections. Let's also talk about a concept most people haven't heard of: self-insurance reserves. For people who are generally healthy and have strong financial positions, the traditional model of buying comprehensive coverage for everything from the first dollar is increasingly expensive and often irrational. Instead, think about health insurance the way you should think about all insurance, as protection against catastrophic loss, not as a prepaid medical card. Carry the HDHP, max your HSA, and maintain a dedicated cash reserve of 2 to 3 times your annual deductible. This reserve functions as a self-insurance buffer for the gap between your deductible and your out-of-pocket maximum. Prescription drug costs are another area with significant optimization potential. GoodRx, Mark Cuban's cost-plus drugs, and similar services can dramatically undercut what your insurance charges for generics and even some brand medications. Always check what your medication costs through these services versus through your insurance. You will sometimes find it's cheaper to pay cash than to use your insurance, and using insurance counts toward your deductible while cash does not, which has its own trade-offs to consider. Healthcare sharing ministries are an alternative some people explore, particularly self-employed individuals. These are not insurance, but member-based cost-sharing arrangements. They can be significantly cheaper for healthy individuals, but they come with serious limitations. They are not ACA compliant. They often exclude pre-existing conditions, mental health, and certain preventive services, and their coverage is not guaranteed. Understand what you're getting into before switching. Finally, let's talk about preventive care strategy. Under the ACA, most preventive services, annual wellness visits, screenings, vaccines, must be covered at no cost under most plans. Use them. Early detection of a chronic condition or catching something like high blood pressure before it becomes a cardiac event is worth far more than any optimization strategy in this video. Your health is your most leveraged asset. The bottom line, managing healthcare costs is a year-round financial discipline, not a once-a-year enrollment checkbox. Choose your plan with full math, not just premium comparison. Max your HSA and invest it. Negotiate every significant bill. Build your self-insurance reserve. And use your preventive benefits. These moves together can save the average family thousands of dollars a year while actually improving their coverage quality. Subscribe for more advanced money strategy, and let us know in the comments. Are you currently on an HDHP? How's it working for you?